All right, we will get started. We have a great group today. Good morning and welcome to session 4 of Capital Matters Source of Credit presentation introduced by Emerge Stronger. We are so happy to have you guys all here today. Please remember that this presentation is being recorded. I think that, yep, perfect, awesome, right on time. Please remember that this presentation is being recorded. Questions will be answered throughout the presentation. So please use the the Q&A section at the bottom here that you can see right at the bottom of the screen. If you have any questions, I will grab those from there and ask on your behalf. Again, please feel free to ask any questions you may have. We're excited to have you here today and want to make sure that everyone is participating. A few housekeeping rules. Your microphones and videos have been muted, so you do not have to worry about being unmuted or speaking while on mute, as many of us have been doing for the past 6 months. Again, please be sure to ask your questions in the chat or the Q&A section right at the bottom of your screen, as I will be monitoring those and grabbing those and to ask the speakers. You will have access to this recording after the presentation. It'll be available through the link below, which is great. So if you end up taking notes or you forget, please feel free to come back and revisit any of the topics that we discussed today. All right, so the Prince George's County Partnership, Prince George's County Economic Development, FSC First, and Bowie Big have partnered to provide county businesses like yourselves with Emerge Stronger, the ultimate resource for successful businesses operating and acceleration in the county and beyond. To learn more about these organizations and what they do to bring Emerge Stronger to you guys, please feel free to look at their websites below. Okay, and so you will actually, again, you'll have access to this presentation, but there's actually going to be, I believe, keep me honest here, 2 or 3, actually 3 more of these presentations, Understanding the Lender's Language, October 30th, Contract Financing, November 6th, and Pivoting to a New Economy, November 13th. This is the best 1-hour investment you can make for your business. So please join us. We will be excited to have you there. Okay, and my name is Miriam Diamande. I will be your moderator for today. I am a business banker or relationship manager at M&T Bank, and I'm very excited about these topics. As you can tell, these are very near and dear to my heart, and I hope that it'll be able to continue to help and grow your business. Perfect. Our first speaker of the day, Dawn Medley, is here today and brings over 25 years of experience as a trusted senior VP and EDI fund manager at FSC First. Her experience includes complex credit analysis, underwriting, and loan closing. Dawn has an array of services and the bank is able to provide and help businesses like yourselves grow. We are honored to have Dawn with us today. Thank you, Dawn. Our next speaker for today is Senior VP and Relationship Manager at Eagle Bank, Doug Dillon. Doug has more than 30 years of experience in buyouts and acquisitions. Doug has also been a key component in working with community banks in the greater Washington area. We're happy to have Doug here today, and we thank you, Doug, for your presence. So without further ado, I will be turning the presentation over to our first speaker, Dawn Medley.
Good morning. Please start my video. So this, on behalf of our President and CEO, Shelley Gross Wade, this is Dawn Medley. As Miriam said, good morning and welcome. I'm going to speak with you today about FSC First and some of the sources of credit that we have available to businesses in the county and throughout the state. FSC First is a premier non-bank lender, and we specialize in offering flexible, risk-tolerant alternative sources to funding such that we can provide an innovative and creative solution to businesses' financing needs. We're also provide loan administration services that benefit small and emerging businesses, and of late, grant administration services as well, as we help businesses survive through the pandemic. Next slide. So let's jump right into it. FSC has an array of very flexible and innovative products. We are certified by the SBA, CDC, and as such, we have the ability to offer SBA supported and guaranteed programs. The first of which is the SBA 504 real estate program. It allows for you to be able to purchase the real estate for your business, or perhaps you're leasing now and you're thinking maybe I should purchase. The rates on this product are incredible right now. I mean, they're record-breaking almost. We're right around 2.5%, between 2.47 and 2.57%, depending on whether you go with 10 years, 20 years, or now you can even go up to 25 years with the SBA 504 product. This product has the ability to go up to $5.5 million, depending on how the project is structured. And along with real estate, you're also able to finance leasehold improvements to a certain degree, and machinery and equipment. This program allows for a partnership of FSC First as a certified CDC partners with a bank partner. And along with your equity, we're able to structure this so that you have an extremely affordable real estate mortgage on your business properties. Another SBA product that we have is our flagship program, Small Business Growth Fund. It is again supported by the SBA Community Advantage Program. This program supports day-to-day operation expenses. We can also use it for smaller real estate deals. Perhaps maybe you have an office condo that you want to purchase, or industrial condo that you like to purchase. Smaller real estate transactions, as I said, and equipment. And this program also has the ability to refinance a certain amount of business debt as well. This is through a partnership that we have with our bank pool partners that contribute to our FSC's personal bank pool. And then we have the ability to then lend those dollars to the business community. And this credit can go up to $250,000. Next slide. We also have micro enterprise loan programs. This product goes up to $50,000 and can be used for working capital and equipment. We also have the VLT Small Business Flex Fund. FSC First is one of 8 fund managers throughout the state. And this is one of our really flexible programs. We serve as an intermediary lender for the State Department of Commerce with this product. The VLT Flex Fund, as you know, is supported by proceeds that do come from the casinos throughout the state. And this program supports working capital needs without requiring a government guarantee or the funding of loan loss reserves. It's very flexible, as I said, and we can lend up to $250,000 with this product. We also serve as a lender service provider for municipalities throughout the county, one of which is the City of Bowie Loan Fund. So if you're a Bowie business owner, you're able to tap into this fund and we can lead you to those dollars because we are the fund manager for the City of Bowie. This program also can go up to $50,000. It supports day-to-day operations, equipment, and working capital, again, for businesses who are located in the City of Bowie. Next slide. VDI Fund is a program that FSC administers for Prince George's County. This program supports job creation and the commercial tax base. It provides for a longer repayment term and flexible interest rates. And this program has some exclusive things that are within the program and more focus the money in certain areas, one of which is through our CAP program or the Contractors Advantage program, whereby the fund can provide up to a 25% guarantee from the county so that you as a business owner can establish lines of credit with terms of up to 2 years with participating banks that we partner with in this program. The former Revere Bank, now Sandy Spring Bank, Sona Bank, and Industrial Bank have been our partners with this program. And then another part of the EDI program is the special assistance for local entrepreneurs, whereby the program is able to provide a preference for business owners who are also county residents. Of course, those county residents have to be at least 51% owner. And so the program is able to have a little bit more flexibility for those business owners who also reside in the county. Now, the EDI fund is all about the economic impact that result from it. So there's you have to remember that there is an extreme focus on job creation, the job retention, or even attraction to the county of businesses from other jurisdictions. Next slide. The CPACE program, CPACE stands for Commercial Property Assessment for Clean Energy, is a program where you can get financing for energy efficiency or conservation or renewable energy measures for commercial buildings. The key here is that you must own your building. And with that, you're able to pay for those energy efficient improvements or enhancements or retrofits to your building via repaying it through your tax bill. Okay, so rather than getting a mortgage per se, the debt is serviced for that loan by putting that bill on your tax bill. And so if you sell your building, then that bill conveys with the building. And so it's not a mortgage in the traditional sense. Again, it is billed along with your property taxes. The Green Energy Loan Fund has just been expanded, where now we can do direct loans as well as guarantees and support loan loss reserves up to $250,000, again, for the same purposes and use of funds as CPACE. This program is supported by the Pepco Exelon sponsored this program. And again, same uses, energy conservation, energy efficiency, renewable energy, but this is a direct loan of up to $250,000. Unlike CPACE, which is on the tax bill, Green Energy Loan Fund is a direct loan that FSC administers for the same uses for green energy. Next slide.
Dawn, we actually had a quick question.
Okay.
FSC, what credit is required for your alternative loans?
So we're not credit-based lenders. We do, of course, pull your credit, and that's part of the scenario. But there isn't like a minimum credit score per se. So we're looking at, we understand businesses, especially now, are struggling. So we look at the whole holistic approach to the loan, and not just, it has to be a minimum credit score. It also has to deal with how is the business cash flowing, what available collateral there is, the character of the business owners, the capacity of the business owners, meaning their experience in the industry, whether it's a startup or not, how much equity is available to contribute to the project. So it's an array of factors. It's not just a credit score. So there's no minimum score or maximum score for that matter. FSC First also, again, assists not just local jurisdictions, but other entities like the Purple Line Business Assistance Fund was created by the County Council. And again, it's to provide assistance for businesses that are directly affected by the Purple Line construction. And we also are supported by the Washington Gas Light Company, and we're the administrator for the Strive for 35 program, whereby the purpose of the fund is for the development of minority-owned, women-owned, and service-disabled veteran-owned businesses interested in serving in the natural gas industry. And that's a loan of up to $50,000. I should say that also the Purple Line Assistance Fund is a grant as well. Next slide. I mentioned earlier that we're a lender service provider for a few jurisdictions in the county. Another one besides Bowie is the city of Mount Rainier. Again, this is loans that are supported by the city. They have $1 million incentive fund, and we are administering loans for them for up to $50,000 for many of the same uses that you've heard already today: leasehold improvements, machinery and equipment, and other businesses, a tangible business, things like inventory and things like that. The Business Expansion Fund is a program that FSC administers for the Prince George's County Economic Development Corporation, our sister organization. And again, this assists local small minority businesses in the county with bridge financing for business expansion purposes, and also has flexible financing options, and the available loan amount depends on the size and scope of your project. Next slide. Other sources of credit. So FSC, because of our relationships and partnerships, we're able to utilize and leverage those partnerships to create capital stacking, right? So sometimes it's going to take multiple solutions to meet your needs as a business owner. And so we are able to partner with funds that are available at the state of Maryland, as well as other local jurisdictions that you just heard today, and other non-bank lenders like ourselves to create an innovative capital stacking, restructuring, and or refinancing. So sometimes the solution has many levels, as you can see here in the photo, many levels of money sometimes have to be stacked in order to create the solution for you. And the solutions that FSC brings are customized, because we realize that not every business has the same need or the same background capacity. And so we customize a financing solution that suits the business's ability to repay, as well as the business's background experience. And sometimes who you partner with understands your business better. And so we know who those players are. We're able to help you find the right financing mixture for your business. Next slide. Thank you very much. I think Doug is next.
Thank you, Dawn. And you are correct on that. Doug is next. Doug, thank you.
Well, thank you. Good morning, everyone. As Miriam said already, my name is Doug Dillon. I am a 30-plus year banker at this point, and I've worked in the DC market for the last 20 years after previously spending some time in the Chicago and Kansas City markets. Let me just start by saying that we're on the opinion page. Any views and opinions that are expressed here are mine and not those of Eagle Bank. However, I'm going to try and steer free of opinions and talk to you about just the way the bankers think about specifically mergers and acquisitions, which is the topic that I really address here today. So I don't know if my picture is turned on, but I'm looking at the screen with you. Before I get into all the numbers, I did want to say just a few things. I am not going to focus so much this morning on mergers. In markets, small business markets, and I'll define that as revenues of less than $25 million, there's not a lot of mergers between equals. There's usually an acquirer and the company that's being eaten, basically. And so there's not a lot of, two different owners, two different presidents, that kind of thing, which can be complicated in and of itself anyway. So I'm going to focus on the subset that really is acquisitions, and in addition, really focus on asset purchases. And I'll talk a little bit more about that later, but not stock purchases, asset purchases. And I will apologize in advance if you should happen to hear some singing. My wife is upstairs. She's an elementary music teacher. We're all in a COVID environment. My younger son is a high school senior. He's sitting right above me. So as I said, hey, it's COVID. At least my older son is at University of Maryland, so there's no issues there. So I do appreciate the conversation about programs that Dawn just went through, and we do definitely work closely with FSC First and with SBA to finance a lot of those opportunities. But to get right down to brass tacks, at some point, you'll probably have to deal with a bank if you're talking about doing some type of acquisition. You'll want to go to the bank and say, I'm interested in acquiring this target. So I want to familiarize you with some of the questions that will come up from the banker's side. And leaving aside the numbers for just a second, probably the first question the banker is going to ask you is why? Why do you want to acquire this company? Are you going after more market share? Maybe you think, I've got a certain amount of market share, and if I acquire this company, I can capture more, maybe even corner the market in my local area. I've heard that conversation quite a lot over my career. Maybe it's vertical integration. I was working with a Chicago rope manufacturer some years ago that brought their supplier of plastics. And when you look at the way that operation works, they get these plastic pellets, and they didn't want to pay the upcharge to the supplier, and the supplier was open to being purchased. So they basically said, let's go out and buy the supplier and cut down on some of our costs, and maybe also cut down on some redundancies. Maybe it's just an opportunity. A lot of times there's an older person that might be retiring, or maybe someone's just been very successful in retiring, or maybe sometimes there's a company that's in trouble and says, I think I better bail out of this situation right now. Well, obviously that latter situation will put a lot of questions into your banker's mind, right? Okay, why is the company in trouble? Are you basically going to inherit some of those same troubles? So those are questions that will be asked by your banker. Another question, which would be particularly relevant right now, is it the right time to do this? Obviously, in the COVID-19 environment, it could make something like an acquisition much more difficult because you don't know exactly what to expect in the market. And so therefore, it's a little bit more risky to acquire something when you can't figure out what's going to be happening 6 months from now. And even when we come out of COVID-19, frankly, the economy is likely to ramp up slowly. There's probably going to be some uncertainties about where we go with the economy going forward. So those are some of the questions that a banker, I think, is going to want to talk to you about. And it's a good conversation to have. I've had one situation where someone actually changed their mind after going through all those different kinds of questions and really thought about it a little bit more. But let me get to what's up on your screen right now, which is the question of valuation. Is it the right price? If you're looking on your screen, basically what we're talking about here is a company, and I'll try to take you through the numbers real quickly. This is RST Company, which is an acquisition target. And we're simply looking at the cash flows of RST Company to see, whether or not it's a viable acquisition target, and also how much cash it's throwing off, and basically whether or not it services the debt and what value can be attributed to it. So if you look at this is the profit and loss statement for, let's say, last year, obviously a hypothetical situation. But RST Company has revenues of nearly $26 million. Their cost of sales is $9.5 million, so their gross profit is 16.3. You go down and look at all the operating expenses. At the end of the day, this company lost $365,000. And you might say, whoa, what do you lost $365,000? That's not all that uncommon. People manage their business so that they're not going to have to pay a whole lot of taxes. It's not all that uncommon to see somebody with the bottom line that is negative. However, the trick of the trade for bankers is adding back in things that are non-cash expenses, or things that are non-recurring expenses. So I've put a bunch of arrows over on the side of some of these expenses just to explain some of that. Going down from top to bottom, officer compensation here, let's say it's a single owner, was $600,000. Well, let's say you're acquiring the company, and I don't need to take out $600,000. I'm going to take out, let's say, $250,000. Well, a lot of that money, $350,000 to be exact, could be added back to your cash flow. So you can see with adding back $350,000, you're almost back to even in terms of the $365,000 loss. Depreciation for the company, which typically is considered a non-cash expense. For some companies, it might be a real economic expense, but depreciation is generally considered a non-cash expense. You're not actually paying somebody for depreciation. That can be added back. So that's $1,540,000 right there that can be added back. I put another arrow that's not shaded in. Rent sometimes can be added back if the owner of the business owns the building in which it's operating. And if you're going to own it afterward, that basically means you're paying yourself rent. I did not add it back here, so that's why that's not shaded in, but you should just be aware that that's something that could be added back. And interest expense, banks are going to add that back as well because you're basically paying that interest expense to your bank. So they consider that as cash flow that is coming in that ultimately they can benefit from. So if you look on the next page with all those additions, we have the $365,000 loss, $350,000 added back, which is the excess owner compensation, depreciation of $1,540,000, and interest expense of $975,000. Well, when you put all that together, what this thing is called seller's discretionary earnings is $2.5 million. And you can see the definition of seller's discretionary earnings up above. It's prior to income taxes, non-recurring income and expenses, non-operating income and expenses, depreciation and amortization, interest expense or interest income, and owner's total compensation for one owner operator after adjusting the total compensation of all owners to market value. So that's basically a fancy way of saying this is the cash that you can expect this business to generate for you. There's another calculation there too, EBITDA, earnings before interest, taxes, depreciation, and amortization, which basically the only difference between the two is that I'm not adding back the $350,000 of excess owner's compensation in the EBITDA calculation. Now, why is this important? Well, it's important for a couple of reasons. Number one, your banker is going to want to know how much cash is this business throwing off, because I want to know whether or not the business can repay a loan. And without going through all the manipulations of calculating this right here, I basically gone through and calculated that at $2,150,000 of EBITDA, this business could support a debt of right around just under $7.6 million. So that is, for this business, you look at a revenue of 25.7 million, a net income that's slightly negative, but it's got a pretty good cash flow. You could probably get a loan somewhere around $7.6 million. That's assuming a 5% interest rate, a 5-year term and amortization. You could probably get, and the payment is calculated in there. You could probably support $7.6 million loan. If we go to the next page, what you'll see here on the next page is that we're talking about valuation now. The way that bankers and other financiers tend to look at valuation is a multiple of those cash flows. So an enterprise value, which basically the amount that the business would sell for, if you had to sell it off, what would it sell for? Enterprise value is represented here by EV. And basically what people do is they look at other companies that are similar, maybe in the same industry. In this case, we have an ABC company, an LMN company, and an XYZ company. Just mostly a lack of imagination on my part. So just using companies with alphabetical names, but these are all hypothetical also. But let's say that they're in the same industry. So the acquisition value of these companies, 18.4 million almost for ABC, 35.2 for LMN, 46 million for XYZ. I'll take you to the central column, which is the enterprise value over EBITDA. You can tell historically how much these companies sold, what kind of factor they sold for over their EBITDA, over their cash flow. The average here is 9.8 times. And if you apply that factor to the cash flows from RST company, you end up with a $21,070,000 value. There are other factors as well: enterprise value divided by sales, enterprise value divided by seller's discretionary earnings. If you take all three of those together, the average of all those calculations comes out to 22.2 million. So this is a pretty valuable company. If you're going to buy it, you'd have to pay a pretty penny for it. Remember what I said about the debt that it would support, though. It only supports about $7.6 million of debt. So if you got a company that you have to buy for somewhere near $22 million and it supports only $7.6 million of debt, what does that mean? That means you got to come up with somewhere around $15 million of equity to buy that company. Now, obviously, I'm talking about really big numbers here, but the same concepts apply if you strike a zero off of the end of one of these deals. So it's important to know that there's going to be an equity injection requirement for any deal that you enter into. But this is one way to look at the value of a company. And this is obviously a very hypothetical model. It's overly simplified. So what you really want to do is probably have a professional business valuation specialist take a look at this so that you know exactly what you're getting into ahead of time. If we could take a look at the next page. So we just talked about the equity injection requirement. If there are no constraints on the cash flow of the business, generally a bank is going to require somewhere between 20 and 25% for the equity injection requirement. That's the percentage of the total deal. But it could range from less than that, 15 to 50%, depending on the industry. And if you have an SBA guarantee, it could get as low as 10%. Seller financing is often acceptable as well. The seller might say, you could take back a note and I'll provide some of your equity injection. That can be helpful as well. But banks are usually going to require that the buyer has some skin in the game. You can't, someone recently approached me and said, I got, $10,000 that I can put into this deal. And how much of a loan did they want? They wanted, I think it was $7 million. Well, that's not very much relative to the $7 million. The bank is going to say, we're financing too much of this. You don't have enough of a stake in the success of this business. So please be aware that you're probably going to have to put some of your own money in to this acquisition, or really to any loan request that you put through to a bank. We talked about the level of debt supported. I'll just say that based on that's usually based on the cash flow, either EBITDA or seller's discretionary earnings versus the annual debt service required. Most banks require a debt service of 1.25 times debt service. So debt service is simply the amount that you pay for your loan, the amount of payments that you pay on your loan over the course of a year. Cash flows of affiliated businesses also might be considered in some situations, depending on the commonality of ownership. That's a consideration that could come into play. You're always going to need a secondary source of repayment. Banks need to have that. So even if your cash flow works out totally and you have the ability to pay, banks look for collateral as a secondary source of repayment. That might be real estate, it might be business assets, cash reserves, could be just about anything, but you're always going to need to have some sort of collateral. So please keep that in mind. It's also very important that you have some relevant experience managing this type of business, that you have relevant and direct experience in the industry. Or in some cases, you have situations where there's a key manager of the business and you want to keep that person on. It could be the owner. So you contract with them to basically stay on for, I don't know, 6 months, 2 years, while you're learning the ropes of the business. There could be some equity incentives in that as well. Also, you'll want to consider if you have an owner that's been doing this for a long time and could easily go out and replicate this thing in the same market that you're in, you probably want to have a non-compete agreement so that they don't immediately go out and take all your business. And remember, you're buying a book of business from them. They could easily go out and open up their business again and steal all your business away. So you want to make sure that that doesn't happen. The last thing I'll talk about real quickly is the type of acquisition. I referenced this before. Stock purchases versus asset purchases. Generally, in the small business markets, you want to focus on asset purchases. Stock purchases basically involve buying the equity of the business, but it also involves buying liabilities of the business. So if you have a company that has run up some debt, there's a strong possibility you're going to inherit that and maybe inherit some problems you weren't aware of previously. So those are some considerations when you're looking at an acquisition. And again, as we're all trying to emerge stronger as we come out of COVID-19, if you're looking at opportunities to buy a business or obtain financing for your own business, these are some things that you might want to keep in mind that would be helpful going forward. Again, my name is Doug Dillon. I'm with Eagle Bank. Eagle Bank is a local community bank. We pride ourselves, even though we've gotten to $10 billion in assets and we're able to handle just about every type of transaction. We pride ourselves on continuing to be a community bank where you can get the kind of service that you're used to at your small local community bank. So thank you all for listening, and I'm glad to take any questions you might have.
Thank you so much, Doug. We really appreciate you coming and speaking to us. It's amazing what knowledge can do to business owners. So we really appreciate that. Any last questions? We are still available for questions at the bottom of the screen here. So I think Aisha, do you mind just putting your information in the Q&A section, just so that Doug could reach out to you? And I believe the last slide has all of the contact information for the panelists. Perfect. Awesome. So please, yeah, definitely take some time to write these emails down. Again, this presentation is recorded, so you will have access to those.
Miriam, there's a few questions in the chat.
Oh, perfect. Let me just take a look here. Okay, so the first question is, can you explain what are eligible costs for leasehold improvements?
So a leasehold improvement, if you are leasing a building, so generally it's any permanent fixture that you attach to a leased property. So when you start a business, sometimes it's just a warm lit shell when you see it. Sometimes the previous business has been there, and maybe there's some walls that were put up. That's a leasehold improvement. There was some maybe special lighting installed. Those are leasehold improvements, but you can change those internal things, especially if you're maybe a hair salon. Then you're going to have some leasehold improvements, like installing shampoo bowls and different booths for the stylists. We had one business who was on the second floor of a commercial building. There was no elevator, it was a walk up. And so she wants to install a chairlift for her ADA customers. so that they can access her business on the second floor because there's no elevator. That would be a leasehold improvement. So in general, think of it as a permanent fixture or wall that is, you can't take it with you if you move your business. Think of it that way. You can't take it with you. So if there's an open space and you create walls and doors for offices, that's considered a leasehold improvement.
Perfect. Thank you so much for that, Dawn. And we have a couple other questions. The next one is, what is the typical amount percentage-wise and sources of equity that are acceptable to leverage any cash that a borrower will put into the project they're seeking financing for?
Generally speaking, and Doug can also jump in, generally speaking, it's going to be 20%. In some cases, like in the case of the SBA 504 program, especially if you're a startup, you need, or you don't have a long business experience, you can expect that you should be able to have to put in 20% for your project. In some cases, with the SBA 504 program, it's as low as 10%. And that's also something that makes it a great program compared with sometimes with traditional lending. The SBA 504 program, when you're purchasing real estate or heavy machinery and equipment, you can put down as little as 10%. That's something else that makes that program so much more affordable. You can also wrap in the cost of that loan into the loan as well.
I would simply add that in terms of the nature of the equity injection, again, it's very important that a lot of that come from your personal resources. If you're getting gifts from other people, if it's seller financing, again, I know banks and most lenders will not look at that as you having a lot of skin in the game. So try to have some of your own money in the game. I would say 10% would be a floor for most people.
Okay, we have a couple of other questions. When is it appropriate to use FSC First versus a traditional bank like Eagle Bank?
So FSC First, again, is a non-bank lender. So we're going to, and we're also considered part of the economic development cluster. So when we look at a project, we're looking at all the variable factors. So we're looking at normal things, the 5 C's of credit, if you will, that a traditional bank would look at, but we're also looking at projections as well. We'll consider projections of what the business is going to do. We'll look at a startup versus we'll look at certain other industries that banks sometimes may shy away from. And so FSC First is, as I said, flexible and innovative. So we'll look at a lot of things that sometimes it's a little harder to get done in conventional banking, especially if you're a startup. However, FSC First has the ability to do lending like a bank does, especially when it comes to, like I said, real estate, leasehold improvements, machinery and equipment, and inventory.
And I would simply say that some of it is a question of magnitude. When you get to the larger deals, it's going to be appropriate to come to a place like Eagle Bank that still has a lot of flexibility, that still is willing to look at your individual situation. But if you're talking about something that's on the order of, I don't know, 2 million, well, that might be small, 5 million, $10 million, it would be more appropriate to go to a commercial bank.
So I would also say that, and sometimes we'll partner like with Eagle Bank, but FSC has created capital stacks in the realm of 6-9 figures, multi-million dollar projects, because we have so many programs. We're able to stack them and put all the money together and create some very large projects. I believe that the largest project to date that FSC has participated in, it was around $150 million.
Great, thank you guys so much for that. Can I get pre-approved for a loan before all of the project costs are identified?
I would say the answer to that is generally not. We're going to want to have a full package to make sure that we understand everything that's going on. So yeah, you're going to need to identify the sources and uses of the loan proceeds. That's going to include all the project costs. You might be a very solid candidate personally relative to your prospect of obtaining a loan, but particularly in this environment, particularly these days where the economy itself is so uncertain, that will create an additional layer of complexity that requires us to really understand the business really, really well.
Perfect. Thank you so much, Doug. And sorry, Bertha, 1 second. There's questions coming in left and right, so we are doing great. What are my options if I bring in cash, but my tax returns show low profit? Are there options that look at the bank statement rather than just a tax return?
So I'll go first. I'm sure Doug has something to say about that. So if I understand the question correctly, the tax return versus, you said bank statement, but I'm going to broaden that to your financial statements, right? If you remember, Doug reviewed some items that are generally added back in, especially if you're looking at a tax return, you're looking at things that are deductible by the tax code. But when it comes to a financial statement, there may be things that are tax treatment, and you do that on your tax return, like depreciation and things like that, that as Doug showed you, remember he had the arrows and some were shaded, where a lender can add those items back in, which at the end of the day improves your bottom line cash flow number, which will improve your overall debt service. It's a different treatment when you're doing your taxes, when you're looking for things that are deductible that are not necessarily cash.
And I pause a little bit because a lot of times people try to prepare for talking to a lender and they kind of talk themselves out of doing it. I would just encourage you to call and let's talk through your individual circumstances, because you never know. There might be something in there that would persuade a lender that, oh, this is a good deal. So it's just a question of generally having the courage to pick up the phone and say, okay, I'm going to take a chance here. Let's talk about it.
Thank you, Doug. And Don, does FSC First work in DC?
No, we do not. The state of Maryland only.
We do.
Perfect. And do you need to bank with FSC to get approved for a loan?
No, we're not a bank, so we do not hold deposits. So Eagle Bank is a bank, they can hold deposits and do that kind of retail banking. FSC is not a bank in that we do not have deposits. We function very much like a community bank, but you can't put funds on deposit with us.
Perfect, thank you. Does FSC First work with real estate investors?
Yes, we do. And in that, so if you're talking about, when you say real estate investors, in that you are maybe flipping houses, that's considered a passive activity, if you will. You're not a business owner that is occupying the building. But again, when it comes to real estate investing, there's all different flavors of that. So I would give you the same advice Doug just gave you, to come talk with us and let us talk through exactly what you're doing, how you're doing it, how the money is made for the business. And we'll be able to kind of give you a better evaluation of whether what you're doing is an eligible use of our funds.
And I believe this is our last question. Does FSC, do you do lending for automotive manufacturing?
Possibly. We do lending for manufacturing. There are programs that are designed specifically for manufacturing. We would need to, again, talk with them more about the scope and parameters of what the business is doing.
And that was our last questions. Any last comments or statements, panelists?
Well, I just want to say thank you for your attention and for listening. Obviously, this is a very difficult time in our economy, but there are always going to be opportunities that are out there. So again, please, if you come across an opportunity, don't be shy. Call up and talk to a lender. Anybody that you're seeing right now could be helpful to you in that capacity. So thank you again.
I would say the same thing. Thank you. Thank you for this opportunity to speak with you this morning. And just know that you can emerge stronger in this environment and better, and continue to grow and expand your business.
Yeah.
Thank you all so much for joining this morning. I think this was so useful. And if you are interested in joining us, we have 3 more of these coming up. Again, this is the best 1-hour investment you can make for your business. So please join us. We have Understanding the Lender's Language, October 30th, Contract Financing, November 6th, and Pivoting to a New Economy, November 13th. All exciting topics. Again, thank you so much for your time. We really appreciate it. And have a great rest of your day and a good weekend.